If you invested $10,000 in Tesla with founder 10 years ago, your stake would be worth around $2.1 million now. That works out to a more than 70% average annual return. Doesn't that sound awesome? But the reality is different. Around 90% of people lose their money in the stock market, including both novice and seasoned investors. The stock market might be risky at times but rewarding in long term. If you do not have a sound understanding of the market along with fundamentals of investing, then instead of making any profit, you are most likely to incur losses in the market. Even the greatest English mathematician Isaac Newton lost his fortune in the stock market. He was one of the early investors in South Sea Company, which was founded in 1711 to trade with Spanish America. In 1720, the company bagged a deal to manage British government debt. As soon as the news spread, the price of the South Sea stock started soaring. He took a wise decision to book the profits in April and made a profit of about £20,000, a great figure in those days. As the euphoria around the stock kept on inching higher with every passing day and his friends were making huge profits, Newton couldn't resist the temptation of buying the hottest stock once again, perhaps afflicted with FOMO, the fear of missing out, and jumped back in at a much higher price in June that year. Unfortunately, in September the price of the stock plummeted and he lost all his early profits and a good bit more besides. In spite of his general brilliance and expertise in finance, he committed such a financial blunder and lost much of his fortune. The experience is said to have given rise to his bemused response: "I can calculate the movement of stars, but not the madness of men." He obviously was not a dumb person. He invented calculus and conceptualized his 3 laws of motion. If a genius with IQ level of 190 can commit a financial mistake, you can think about common investors. Fundamentals are the bedrock of investing. The stock market is not all about the play of luck. It requires good knowledge and understanding of the market and how it functions. The stock market can earn significant returns, but you can also lose all your money if you invest without knowing the nitty-gritty of the market. There is a famous saying, "Don't dive in deep water if you don't know swimming basics." This saying holds even in the stock market. Refrain from investing your money if you do not understand the elementary concepts. Knowing the field will help you make intelligent decisions, which will benefit you in the long run. Therefore, it is crucial to invest only after acquiring the basic knowledge of the stock market. This is the most common blunder people make when they first start investing in the stock market. They trust the advice they receive from a friend, neighbor, coworker, brokerage business, or any financial channel they have recently watched. The majority of individuals mindlessly follow these advice, which eventually turn out to be a huge loss on their investment. Certainly your friends or brokers have more knowledge than you and can assist you in getting higher returns. You, on the other hand, are missing the point. No one is more concerned about your money than you are. They don't care if you make or lose money. Brokers only make money if you trade with them. Whether you win or lose, it makes no difference to them. As long as you are continuously buying or selling, they will receive their brokerage fee. As a result, they will always aim to provide recommendations so you can trade more frequently. The more you trade, the more money the broker will earn from you. For example, you have 7 shares, 5 of them are doing exceptionally well, while the other 2 are underperforming. Which stocks are you going to sell first? The underperforming or the one doing exceptionally well? Most investors prefer to sell their winning stocks and simultaneously hold and increase their exposure to the losing ones. It's a phenomenon known as the disposition effect. It's an anomaly discovered in behavioral finance. However, this is the wrong approach. You're restricting your upper profit level while increasing your downside risk. In other words, by selling your winning stocks, you are reducing the amount of profit you can make. You're willing to take a 20 to 30% profit when these stocks can go up and provide you profits of 200 to 300%. Because the losing stocks are still in your portfolio, you may incur a bigger loss. You must take the opposite approach if you don't want to lose money in the stock market. If your non-performing stocks are still not performing after a reasonable amount of time, you must sell them. This can be accomplished by holding to your winners and selling your losers. If everyone is thinking alike, then somebody isn't thinking. Herd mentality is a thought process that makes an investor follow a trend or a movement. Most of the investors make investments just because other investors are investing in a particular stock or a sector. This, however, may not be a wise move for an investor who has his own unique set of objectives or financial plan. These decisions are made by just following a large group of people without considering important aspects of investing like valuations, risk factors, the investors' backgrounds and their investment styles, and the reasons thereof, and so on. It is very important for an investor to know himself and his own psychology, risk tolerance, investment time horizon, and risk-taking abilities, amongst other factors, before mindlessly following a herd. Steps investors must take to avoid losing money. If you fail to plan, you plan to fail. This is especially true in trading where risk is ever present in the markets. A trading plan is not merely a trading strategy. A trading strategy will guide how you will enter and exit trades in the markets in a manner that enhances profitability and reduces risk exposure. A trading strategy can be based on technical analysis or fundamental analysis. A trading strategy is just one component of your overall trading plan, which goes beyond that to also capture your overall trading goals and motivation. When you purchase a stock, you own a stake in the company. Therefore, before you make your first investment move, it is wise to know the company you wish to invest in detail. Get an understanding of the company, its business, plans, customer base, competition, etc. We are sharing some key areas which you need to be familiar with before you begin. You must be wondering as to how and where do you acquire this knowledge. So let us get to that. One of the essential sources for gathering information about a particular company is quarterly financial information. It is readily available in public domain and also with most of the good brokers in an organized format. You can review the company's balance sheet, profit and loss statement, and cash flow statement to assess the company's financial position. That will give you an idea of its sources of funds and how it handles its cash, revenue, and expenses. Studies show that investors feel greater pain from investment losses than satisfaction from investment gains. Investors who were hurt by past financial crises, for example the technology bubble or the Great Financial Crisis, have a justifiably heightened fear of investment losses. Emotions can cloud a person's investing decisions, causing him to make decisions that are not in his best interests. Emotions are tough to overcome, especially when it comes to losing your hard-earned money. Greed and fear can easily take control over a novice trader's mind after a streak of good or bad trades. When greed kicks in, you will begin to bet too much money with each position, open more positions than usual, and often double your bets when you see that your option is currently in the money. Conversely, when fear sets in, the trader will avoid entering good positions and bet less money than he should, missing on a lot of possible profits. Therefore, sticking to a trading strategy will allow you to disregard volatility in your current performance, which will help you rule out emotions and focus on your long-term success. Emotions shouldn't cloud your judgment, irrespective of whether you trade under fear or greed. The purpose of investing is not just to earn the highest returns, but to help one to predictably and easily achieve the various objectives and goals. For this to happen, one needs to always consider investment time horizon and risk appetite before making a financial decision. Some investors wait for the right time to enter the markets. These may not be the right strategy to invest for long term. Market timing requires investors to find the best time to sell and then again buy when the market is at the bottom. Here you are predicting not once but twice, and only in hindsight does one know the market peak or trough. Waiting for the right time to invest may potentially reduce your returns, as you will waste a lot of time not participating in the market. Therefore, it is prudent to invest without waiting for the right time and be a long-term investor. Asset allocation helps to determine allocations to different asset classes within your investment portfolio. Asset allocation helps to diversify your portfolio as it combines different asset classes and therefore provides your portfolio with both the possibility of growth and potential protection against loss due to the fact that different asset classes perform differently over different time periods. Rebalancing is about sticking to the long-term investment plan and not timing the market. Rebalancing is one way for investors to position themselves to withstand a downturn in the market and participate in the recovery as well. Extreme market events, a bull or a bear market, may change your asset allocation drastically. And therefore, rebalancing your portfolio on a timely basis is an important aspect of asset allocation.